Today on CryptoUK, court victory precedent. IRS may not tax staking rewards until sold. And UK tax agency cracks down on rules around DeFi lending and staking. A couple from Nashville opened up a case against the IRS and compared unclaimed and unsold crypto rewards to an unsold book from a writer, and will be rewarded a refund with interest for tax paid. A Nashville couple, the Jarretts, filed a complaint against the United States government and a lawsuit over taxes paid on unclaimed unsold staking rewards. The decision may set a precedent for the future guidance on how crypto rewards earned through staking are taxed. The new development suggests they should only be taxed when they are sold for USD. The complaint also claimed that the government was attempting to do something unprecedented, which is to tax creative activity rather than income. Taxing newly created cakes, books, or tokens as income would have far-reaching and detrimental effects on taxpayers and the US economy, and is without support in the Internal Revenue Code, regulations, case law, or the Constitution. Forbes reported that sources close to the matter say the couple's plans to pursue the case further in court to obtain longer-term protection and set a nationwide precedent. American taxpayers are likely praying that no legislative response to this court outcome resembles the UK's regulator's new guidance on crypto staking. There, staking crypto will often be considered as the sale of tokens and will incur capital gains tax. As the UK cracks down on rules around DeFi lending and staking, Her Majesty's Revenue and Customs, the HMRC, UK's tax agency, on Wednesday has relisted a controversial set of guidance that could affect the innovation in decentralised finance. The updated regulation focuses on the treatment of digital assets, specifically for DeFi, lending and staking in the UK, and whether returns or rewards from these services are deemed as capital or revenue for taxation purposes. Owing to the cutting-edge nature of DeFi, these services have fallen into a grey area, with tax professionals unsure of how the existing rules apply. The lending and staking of tokens through DeFi is a constantly evolving area, so it is not possible to set out all the circumstances in which a lending liquidity provider earns a return from their activities and the nature of that return. Instead, some guiding principles are set out, which you can read up on in the link in the description. The guidance outlined that returns via staking and lending DeFi assets will not be treated as interest, as digital assets in the UK aren't considered currencies, but rather property for tax purposes. However, this approach could create tax problems for stakers, with the guidance suggesting that in many cases it would indicate that beneficial ownership of these tokens had been passed to the platform. This would mean that they were disposed of for tax purposes and incur capital gains tax. Ian Taylor, Executive Director of CryptoUK, asserted the new regulations would create an unnecessary burden for crypto investors that the stock market investors do not face when lending shares. HMRC treats crypto assets as property for tax purposes. However, this is inconsistent with the approach of currently being adopted by government and other regulatory bodies in the UK, including the Treasury and the FCA. Taylor added that the new rules add undue reporting requirements for the consumer and create tax compliance confusion, as investors will have to report on hundreds or even thousands of transactions. This is out of step with the government's stated aim for the UK to be open and attractive as a destination for investments and innovative post-Brexit, he said. Just last week, former Secretary of State for Health and Social Care, current UK Member of Parliament MP Matt Hancock, urged the House of Commons to induce progressive crypto policy to make England the home of crypto. In November last year, HMRC laid out regulations concerning the introduction of digital services tax levied on crypto exchanges operating in the UK. So it's a bad time to be investing in the UK, and it seems a good time to be investing in the United States right now. Countries are starting to realise that they're going to get left behind, and I just hope my homeland realises the same soon. Thanks for watching.